Even if we manage to pull that off, and that's saying something, the real question is, who are we selling this to?
Same people we've been selling it to for the last 2 years, and whoever else will buy it.
But John, if you do this, you will kill the market for years. It's over. And you're selling something that you know has no value.
We are selling to willing buyers at the current fair market price, so that we may survive.
You will never sell anything to any of those people ever again.
I understand.
Do you?
Do you? This is it! I'm telling you, this is it!
Hello, everyone. Welcome to the special weekend edition of Markets Around the World. I'm K2, your host, and we have a packed agenda today. We'll delve into the latest data, analyze key macroeconomic trends, and spotlight the critical levels you need to keep an eye on. If you're as passionate about markets as we are, be sure to subscribe and deepen your understanding of how global markets interconnect. In this episode, we'll explore a broad spectrum of data, news, and macroeconomic developments. So let's dive into what's been driving the markets and take a closer look at what lies ahead. Let's start with the top headlines that are making waves. Morgan Stanley's co-president Dan Simkowitz expects mergers, acquisitions, and IPO activity to remain below trend for the rest of the year. However, he anticipates a pickup next year as central banks cut interest rates. Speaking at a New York conference, Simkowitz noted that declining U.S. rates could drive more transactions, and private equity firms may face increased pressure to strike deals. A Reuters poll shows that most economists expect the Federal Reserve to cut interest rates by 25 basis points at each of its 3 remaining policy meetings in 2024. Only 9 out of 101 surveyed economists anticipate a larger half percentage point cut next week. With inflation nearing the Fed's 2% target and signs of an economic slowdown, policymakers are signaling it's time to start reducing the federal funds rate, which has been at 5.25% to 5.50% since July 2023. Early Wednesday, financial markets suggested a reduced likelihood of a second Donald Trump presidency. U.S. stock futures were modestly lower. The dollar weakened against major currencies, especially the yen, and Bitcoin dropped 2%. Stephen Innes of SPI Asset Management noted that weaker dollar and soft U.S. equity futures align with polls indicating Kamala Harris edged out Trump in the debate. Chris Weston of Pepperstone agreed, citing the market's reaction and Harris's boost from Taylor Swift's endorsement. August's consumer price index came in as expected, reinforcing traders' expectations for a 25 basis point Fed rate cut next Wednesday. However, stocks fell on Wednesday, with the Dow briefly dropping 743 points before recovering, as investors worried the Fed may be acting too late to lower borrowing costs. The Fed funds rate has remained at a 23-year high of 5.25% to 5.5% for over a year. Fed funds futures traders continue to price in 100 basis points of cuts by year end, including the possibility of a larger 50 basis point reduction in November or December. This has raised concerns about the Fed's ability to achieve a soft landing, with some traders fearing an imminent recession. Bitcoin is 29% overvalued, according to a valuation model based on Metcalfe's law, which calculates the cryptocurrency's fair value as a function of the number of Bitcoins mined. Proposed by former commodities portfolio manager Claude Erb, this model has been effective in tempering both the highs of market exuberance and the lows of bear markets. Currently, it estimates Bitcoin's fair value at $40,100, 29% below its recent price. U.S. small-cap stocks are outperforming the S&P 500 in the third quarter, despite suffering more in September. Small caps got a lift when the Fed signaled a shift to easier policy at Jackson Hole, said Liz Ann Saunders, chief investment strategist at Charles Schwab. Small caps tend to do well in rate-cutting cycles, especially when exiting a recession, though she noted, "We're not in a recession." The Russell 2000 index is up 4% this quarter, despite a 4% drop in September, while the S&P 500 has gained 2.5% this quarter, but still leads small caps year-to-date. Investors have grown skittish ahead of next week's anticipated Federal Reserve rate cut, the first in 4 years. Traders have been buying treasuries, driving the 10-year yield to its lowest level in over a year, while gold has surged past record highs. Meanwhile, the U.S. dollar has weakened in recent months as the Fed has taken a cautious approach to rate cuts amid easing inflation. According to PIMCO's Mark Seidner and Pramod Dewan, the dollar has typically declined, at least temporarily, around past Fed rate cuts since the 1990s. Now let's dive into some more data that I'd like to share with you all. U.S. job market deteriorates. Further, the number of permanent job losers not on temporary layoff increased by 324,000, or 15% year-over-year, reaching 2.46 million in August, the highest since November 2021. This marks 16 straight months of increases, the longest streak since the financial crisis. Is the Chinese economy collapsing? The number of startups founded in China dropped to just 260 in 2024, down from a peak of 51,302 in 2018. Additionally, fundraising has plummeted by 96% over the past 2 years. China used to be the best venture capital destination in the world after the US. Investors are holding one of the lowest long positions in WTI contracts in the past decade. I'm comfortable taking a contrarian stance on this, as the potential for inflation to resurface is one of the most overlooked views in today's market. Consumer credit card charge-offs at U.S. banks have risen 3% year-to-date, reaching their highest level in 13 years. The percentage of uncollectible debt has more than doubled in 2 years, according to an FDIC report released Thursday. This surge is driven by elevated interest rates, rising prices, and economic uncertainty. Americans now owe a record $1.14 trillion on their credit cards, with an all-time high interest rate of 22.8%. Additionally, the average debt balance reached $6,329 in Q2, up 4.8% year-over-year, signaling U.S. consumers are struggling to manage their debt. 37% of U.S. small businesses have seen their earnings drop over the last 3 months, the highest share in 14 years, and even worse than the 35% seen during the 2020 pandemic. Over the past 3 years, small business earnings have steadily declined, driven by rising labor and material costs alongside weakening sales volumes. Recently, small business sales expectations fell to their second lowest level in 4 years, signaling that small businesses are struggling, as if the economy were already in a recession. While August CPI inflation stands at 2.5%, inflation in many basic necessities remains much higher. Car insurance, 16.5%. Transportation, 7.9%. Hospital services, 5.8%. Homeownership, 5.4%. Rent, 5.0%. Car repairs, 4.1%. Food away from home, 4.0%. Electricity, 3.9%. Though inflation is at a 3-year low, prices continue to rise. Meanwhile, over half of Americans believe the economy is already in a recession, highlighting ongoing consumer struggles. Global market volatility has surged. World stocks lost a massive $4.1 trillion in market cap last week, the largest drop in 2 years, twice as much as the previous largest drawdown of 2024. The U.S. market alone accounted for around 54% of this decline. The S&P 500 and NASDAQ fell by 4.3% and 5.8% respectively, marking their worst start to September since 2001. The S&P 500 also experienced its largest weekly drop since the March 2023 regional banking crisis. It's a great time to be a trader. The key risk, in my view, remains the myth of what happens to the overall index when its largest components hand off to the smallest. We might be in a market cycle where most stocks rise, but the index itself doesn't. Stocks added $1.3 trillion as traders expect the Fed to cut rates. Prices for producers went up a bit, with inflation staying low. The ECB cut rates to 3.5% due to a weak economy. Defensive stocks may help the market stay stable. Gold hit a new high, and oil prices jumped 3%. Wall Street is betting on a potential half-point Fed rate cut, driving small-cap stocks higher, while big techs lag. The Russell 2000 surged 2%. There's a 40% chance of a rate cut next week, with investors expecting further easing this year. Treasury yields fell, and gold hit a new high. The ECB tried to stop risky loans but faced problems. Banks didn't follow the rules, and a recent check showed issues with how the ECB looked at these loans. Banks say the rules are too tough, and now the ECB is reducing its demands. This situation might hurt the ECB's image. The last data I want to show you guys is small equity markets, especially in Asia, are gaining attention as bigger markets like the US, Japan, and India slow down. Thailand, Singapore, and New Zealand saw notable growth in September. Investors are drawn to these markets due to lower valuations and opportunities as global interest rates stabilize. Now let's take a look at heat map S&P 500. What an absolutely insane week one. Technology, strong performance, led by NVIDIA, plus 15.82%, and Microsoft, plus 7.19%. Adobe stands out as a laggard, minus 4.71%. 2. Consumer cyclical, Amazon plus 8.81% and Tesla plus 9.28% show strong gains. The sector overall is performing well, especially in auto and internet retail. 3. Healthcare, mixed results with Lilly up plus 2.33% and Merck down minus 1.68%. Pharmaceuticals and biotech are seeing selective strength. 4. Financials, weakness in major banks like JP Morgan, minus 3.83%, and Berkshire Hathaway minus 2.57%. Visa plus 2.86% and American Express plus 6.12% are notable gainers. 5. Industrials, solid performance with General Electric leading plus 10.57% and Parker Hannifin plus 7.31%. 6. Energy, mixed performance, ExxonMobil down minus 1.32%. But Chevron manages a small gain, plus 1.48%. 7. Consumer defensive, Walmart plus 5.17% and Costco plus 4.49% are strong performers, while Procter & Gamble minus 0.86% lags. Technology and consumer cyclical are leading, while financials and energy are weaker in the short term. Market sentiment update. The current fear and greed index is sitting at 49, placing it in the neutral zone. This suggests that the market is neither dominated by fear nor greed at the moment, but is in a balanced state. Neutral sentiment typically means that investors are cautious, with neither extreme selling pressure nor euphoric buying in play. Actionable takeaway. This balanced sentiment could signal that the market is waiting for a catalyst, like key economic data, earnings reports, or geopolitical events, to sway the direction either toward fear, if negative news hits, or greed, if positive catalysts emerge. Most anticipated earnings releases for the week beginning, September 16, 2024. Here's a breakdown of the key companies reporting their earnings next week. Monday, September 16th, before open. Immunoprecise antibodies after close. High Tide, American Rebel Holdings. Vince Tuesday, September 17th, before open. Ferguson, Wednesday, September 18th, before open. General Mills. After close. Steelcase, Sangoma Technologies. Thursday, September 19th, before open. Darden Restaurants. FactSet Research Systems. Endava Cracker Barrel Old Country Store. Money Hero after close. FedEx, Leonard Miller, Knoll. Lightpath Technologies iPower. Friday, September 20th, before open. Tamboran Resources. Now let's examine some charts, starting with SPY 1 day. The pattern this week shows a potential triple top. If bears can maintain control, the market may decline. With the upcoming FOMC meeting, we could see increased volatility. For 2024, if the price moves above 565, the next target could be 580. Next, let's examine the QQQ 1 day chart. Bears argue that the current trend line could indicate a potential downside for the market. They suggest that if the price falls below this trend line, we might see a further decline. On the other hand, bulls believe that if the price remains above the trend line, it could signal continued upward movement. If the bullish case prevails, my targets are 488 and 500. All right, ladies and gentlemen, that's all for this week's video. Thank you all for watching. If you found value in the content, please be sure to like and subscribe. I appreciate your support, and we'll see you next time. Bye for now.